This video will walk you through the process of entering a new client in RightCapital with some basic information and illustrate setting up a simple plan. We will start by adding in a new client. You can enter the client's name and click to start the data entry process. There's a 6-step process that is used to enter the client data. We start by entering in the basic family information. You can click on the client card to enter the client's date of birth, the planning horizon, which is the age the client expects to live to, and the residence date. And we'll also click on the spouse card to enter their date of birth and planning horizon. You can click on the Add Participant button to add additional cards to this screen. In this case, we will add our family's child, who was born in 2001. We'll now get into entering the client's financial data. We'll click on the salary card to input Test's salary of $100,000, which he expects to grow by 1.5% per year. We'll also enter spouse's salary of $65,000 and leave that growing at 3%. We'll click on the Social Security card. Test has indicated that he intends to start taking Social Security upon his retirement at 65, so we'll leave that as the starting age. From a Social Security statement, we also know the current projected benefit at full retirement, so we'll enter that as well. Similarly, we will input that spouse intends to take benefits upon retirement at 63 and her full retirement benefit. You can also add income cards to reflect additional income sources. In this case, Test has a pension that we want to include. We'll put that in as $17,500 per year, starting at retirement and lasting for life with no annual increase. The next step is to indicate savings, the contributions they are making to various accounts. We'll click on the 401k card here to illustrate Test's 5% contribution to the 401k and to reflect no employer matching. Spouse is also contributing 5%, but has an employer match of 100% up to the first 3% of contributions and half of any contributions thereafter. We're also going to reflect that both Test and spouse are maxing out their contributions to an IRA by adding IRA savings cards and selecting the max option. The next step is the net worth screen. This is where you can input account information either through integrations or Yodlee aggregation or by entering accounts manually. You can specify the account type from a number of different options. You can also either enter the detailed holdings information, tickers and shares, or you can enter the value by asset class, including a broad equity bond breakdown, as we're going to do here. We're going to input $150,000 of equities and $100,000 of fixed income to reflect their 401k value. Next, we'll input their primary home information by selecting the property bar and switching from rent to own. We'll update the purchase price, current value, the annual appreciation, and their property tax and insurance information. So you can see all the property information here in one place. Next, we'll add the mortgage associated with the property by entering a loan account. You can input all the information associated with the loan, including the original amount, the interest rate, the year of origin, the term of the loan. You can link that loan specifically to the primary home, and you can enter the balance. We will calculate the minimum payment You can also add a higher payment if you choose. In this case, we'll set that at $1,000. You can also enter insurance information. By clicking on the insurance bar, you can access group life cards to indicate group insurance. We'll enter one for test. For spouse, there's no group life, so we'll add in her term life policy. You can input the relevant information, including the death benefit, the owner, the annual premium, and when the premium and policy end. You can also use the Other Account option to add additional assets or business interests that you want to include as part of the net worth. You can capture the value of various assets here. You can also specify a year of sale if appropriate. In this case, we'll have it go to the end of the plan so it's not sold. We'll move on to expenses. In the pre-retirement living expense, you can add in any remaining expenses above and beyond what's already been input. So this number should not include items like the mortgage payment or insurance premiums that you input on the net worth screen. You can also add in additional expenses. In this case, our family is planning home improvements in 2018 and 2019, so we'll input $1,000 per month and set the dates accordingly. Finally, you'll see the goal screen where you can indicate retirement information. We'll set up their retirement ages. Retirement expenses default to 80% of pre-retirement expenses. We'll adjust those here. We also default to national average healthcare and long-term care costs. You can adjust these values if you choose, but in this case, we'll leave it as it is. We'll also set up a college goal. You can look up colleges. So we'll indicate that our child is going to Yale University, and we'll pull in those specific costs for the college goal. You can also set up additional goals. For example, planning for a vacation every other year. We'll set that up for $2,000 per year, starting next year through the end of their life. Our clients are also planning on retiring to Florida, so we'll set that up as a relocation goal. We'll say that they're moving to Florida in the year 2030, and when they're there, they plan to rent a place on the beach for $5,000 a month. So that ends the data entry. Once you complete it, all the data resides under the profile menu here, so you can adjust that at any point. Now that we have our data set up, we'll go to look to see how the client's retirement plan is looking. We see that through our Monte Carlo simulation, we have calculated their probability of success at 41%, meaning 41% of the time they'll reach the end of the plan without running out of money. Click on the action items to look at different variables to adjust to try to increase that probability. First, we know that our client is willing to wait an additional year to retire, so we can illustrate the impact of that, bringing us up to 52%. Next, they'd like to be able to fund their child's college expenses, but perhaps they bring that down to only fund half the expense. When we refresh, that brings their probability of success up to 64%. And finally, we know they indicated a desire to take Social Security immediately upon retirement, but using the tool here, I think I can convince them to use a more optimal solution that the software will calculate. In this case, it's going to delay taking benefits until age 70. You can see that this brings their probability up to a much more reasonable range at 74%. We can also walk the client through the range of outcomes of the Monte Carlo simulation so they can see the upside as well as the down. And we can illustrate specific return scenarios that we've set up to compare the current versus the proposed. You can show that under the relatively conservative return assumption, they were previously running out of money, but with our new plan, they're going to make it to the end. We can also illustrate different sequences of returns, so you can discuss the possibility of creating more guaranteed income to hedge against the risk of a large drop in the market closer to retirement. And you can break down the different income sources that make up their retirement income. You can show that 51% of it is guaranteed through Social Security, pensions, and annuity income, and the rest is being funded by their retirement savings. As you're going through the plan, it can always be helpful to look at the detailed cash flows to understand exactly what's impacting the numbers you see. You can look at their inflows and outflows. In this case, you can see that they have a pretty big surplus that's being saved up until retirement. You can see the impact of the influx of cash from the sale of their home. And you can see the large outflows for 3 years until Social Security kicks in, and then see the modest outflows thereafter as their income sources mostly cover their retirement expenses. You can also see the detailed breakdown of income, expenses, goals, so you can ensure that everything is set up appropriately. You can also see other assets accumulate to retirement, and you can look at the breakdown by account type, including looking at the net flows to illustrate how much is being saved and where money is coming from to fund their retirement expenses, including required minimum distributions that are automatically calculated. Once you've set up the baseline plan, another valuable thing to do is to look at the stress tests to see how additional factors, potentially beyond their control, may impact that plan. You'll see the baseline 74% probability of success. That's the proposed value from the analysis screen. And you can see the updated probability of success when stressing the variables listed, like taxes, inflation, or healthcare costs. You can also adjust the stresses to illustrate how levered they are to that variable. For example, if clients are concerned about Social Security, you can show the impact of their benefits being cut in half. Or if clients are concerned about outliving their assets, you can illustrate the impact of living 10 years longer than anticipated. In this case, that will reduce that probability of success down to 48%. Thanks for watching our video, and please reach out if you have any additional questions.